Hello, everyone, and welcome to another installment of the Investing with IBD podcast. It's Justin Nielsen here, your host. And I know last week we were talking about a we time, but guess what? Arusha ditched me. He actually had that other job that he does, for O'Neill Global Advisors. But that's okay because just as Scott St. Clair was able to slip into Arusha's old role at MarketSmith, he's going to slip right into we time this week. Scott St. Clair, of course, is the manager of our premium products group at Investors Business Daily. He's actually, he's run a hedge fund himself before, been a portfolio manager for O'Neill, and yeah, it's great to have you on the show again, Scott. Thanks for being here.
Yeah, it's always fun, and someday I hope that Arusha gets like the job as the head coach of the Raiders or something because I keep finding I keep getting his scraps, but his scraps are very, very good. So,
Not bad at all. And
yeah.
yeah, we're taping a little bit earlier than we normally do. It's Wednesday, May 31st, and we're actually taping this during market hours because both Scott and I have seniors in high school that are graduating today. So we're going to be right after the market close, kind of doing our graduation prep ceremonies for our girls. So that'll be fun. But we also have to address one of the things that we learned about this weekend was that the founder of Investors Business Daily passed away, Bill O'Neill. 90 years old. He had not just a long life, but what an inspiring life. So we'll talk a little bit about some of the lessons that we learned from Bill O'Neill and the legacy that he truly has left in so many people's lives, and certainly for Investors Business Daily and our readers. So we'll talk about that as well as markets and a few stocks that are on Scott's radar. So Scott, let's get right into it. And what do you want to start with? The Nasdaq or the S&P 500? What do you think?
Do we start with the best or do we start with the worst?
Yeah, let's start with the best. And,
Okay,
and then
then I think it's the Nasdaq, right? Or
yeah,
the
yeah, or
or the
or even
Nasdaq
the Nasdaq
100.
100 if you really want to amp it up,
Yeah.
right?
I guess it's it's S&P of one. I think there was a day where the S&P would have been down if not for Nvidia or something like that.
Oh,
So
I'm sure.
it's
Yeah.
very narrow, and I'm going to play devil's advocate a little bit about the narrowness. I know that historically narrowness is not a good sign. It tends to lead to some major tops. If you go back and study it, as markets get more and more narrow, it becomes a problem eventually. But I don't know. Maybe it's just the recency of it. But everybody in their Uber driver knows how narrow the market is.
Hmm.
So I'm not sure if it's that great a signal anymore at this very moment. I don't know. I'm a little bit torn because it just seems like everybody is talking about how narrow the market is, whether it's a podcast, whether it's Twitter, whether it's a Substack. And the contrarian in me seems to think, well, if everybody knows it, it's in the price already,
Right.
and therefore it's probably not that great a signal.
Hmm.
So I don't know. I mean, it's a difficult market. It's um, not as easy or as great as it would seem. I think if you had given me this chart of the Nasdaq and said, "Okay, Scott, when is this?"
Hmm.
Right? This was 25 years in your trading history. The Nasdaq was doing this. What do you think you were doing? Do you think you were using margin? How were you, way out on the limb, fully invested? And based on just this Nasdaq chart, it would be a clear yes. But
Hmm.
that's not the case. I haven't been that pedal to the metal a lot. Picking and choosing my spots and a lot of hit and run
Right.
because I'm a little fearful that they'll pull the rug on it.
Right. And especially I just changed it to weekly view, and I got to agree with you here, Scott. I mean, if you showed me this chart, I would think, yeah, this is the time where you want to be heavy because after a bear market, a lot of times that bounce is so powerful, and you can get, so much traction there. And we certainly started to see that at the beginning of the year in January, where it just seemed like there was a lot more broader participation. If we look at the advanced decline line on the Nasdaq, we use the ticker symbol GMIAA here, and you can really see that in January you had a marked difference in the breadth of the Nasdaq Composite, but that very quickly kind of well, I'm sorry, I'm on the NYSE right now. Let
The
me
New York, yeah. I
switch that to
think it's more
the
pronounced on the
Nasdaq,
Nasdaq. Yeah.
GMIAB, on the Nasdaq. Yes, right here in January is where it had a nice uptrend, but the downtrend has been really persistent here, for the Nasdaq. Not as much of a persistent downtrend for the NYSE, but uh, again, with the leading index being the Nasdaq, you certainly wouldn't expect um, this narrowness. And getting back to your point, I mean, you look at the chart itself, and you would just expect a lot more of an easier time than it's been.
For sure. Yeah. It's Microsoft, it's Nvidia, even Tesla is starting to perform again. Apple. I mean, I yesterday I was looking, I was a little bit shocked. I mean, Apple is at a
Hmm.
52-week high,
Right.
and it's within, I think, a couple of dollars of an all-time high. I think there was a time where it printed like
Hmm.
182 very briefly. Yeah.
Yeah,
So
182.94 back in January of 2022.
so it's, it's hard to be, I know it's not, it's Apple and it's very narrow and it's, I don't know how, I haven't been in Apple in a long, long time. I've missed this one.
Mhm.
I've always, in the last period, and wrongly, as you can see, Apple's gone nothing but up. But I always felt it was overowned and a bit waterlogged, and that it would
Yeah.
just be a market performer.
Hmm.
So if the
Yeah.
Nasdaq was up 10%, you might make 12 in Apple, and if the Nasdaq was down 10, you'd probably lose 12 in Apple. But so far this year, um, Apple has I've been dead
And
wrong
and, and
on
I don't
it.
I don't think you're alone in that assessment. I think
Yeah,
that was
it's
kind
probably
of
why it did what it did, is because
exactly.
we all thought the same thing.
Right. Yeah, because I was right there with you. So now, part of this, you could argue, well, if that's the way this market is, why fight it? Why not just own the stocks that are working? If it's a narrow market, just own the narrow stocks, the ones that are working. Is that feasible?
Sort of. I think so, a little bit. As an individual investor, if you're managing your own money, you have a lot more flexibility. You can get in and out a little bit quicker. And yeah, and I said it on IB Live, and again, it's a little bit tongue in cheek, a little that, obviously it's better if we have 500 great stocks to choose from, and then I want to try to find 5 to 8 stocks.
Hmm.
If I'm only going to own 5 to 8 to maybe 10 stocks max, why do we need massive breadth, right?
Hmm.
And food for thought. But I understand the idea that with breadth comes more options.
Right.
But you just
But
have to,
also, I think it's also a kind of an odds game. Your odds of finding a winner are a little bit better when there's 500 winners to choose from as opposed to 10.
for sure. I guess the old bag of marbles
Right.
game, right?
Exactly.
If
Yeah. If you're going to
if
choose red ones, it's nice to
yeah,
have a lot of red ones in the
yeah,
bag.
which bag would you rather? There's a bag with 80 red and 20 blue, or 50-50, right?
Yeah.
So
Mhm.
yeah, for sure. But yeah, and I've been doing that a little bit. Like there was a few days ago, I owned Nvidia, ASML,
Mhm.
Micron, and I was thinking, you know, they're all one and the same.
Yeah.
If Nvidia goes down 10%, Micron, ASML, Marvel, I even bought Marvel very briefly, MRVL, they're going to go down 10% as
Yeah.
well. So
Mhm.
I might as well just own one. So a few days ago, or a few trading days ago, I guess, maybe Thursday of last week, I just switched it all pretty much to Nvidia.
Mhm.
And that way it's if I can manage it a little bit easier. And I find, for me, I do much better when I have a larger, more concentrated position. I tend to, if I put on these little smaller positions, sometimes they can get away from me because I
Yeah.
just think, oh, well, it's just a small position.
Right.
So, and this is, and we'll talk about Bill, of course, but I learned that from Bill. I've always been
Hmm.
super concentrated because we've all heard the incredible, great, the good stories, of course, like
Right. Of how
the the
concentration worked for
the
Bill.
Amgen, yeah, or the Price Club or the
Mhm.
Pick and Save. I'm sure there was a few where he got concentrated and they turned against him and he got out
Mhm.
quickly. But
Mhm.
history's told by the winners, right?
Mhm. Right. Yeah.
So I've always been, more of a, let's be concentrated. Let's have a position that can matter if you get it right.
Mhm.
And then you have to put all your eggs in one basket and watch that basket closely. I think Mark Twain said that, allegedly.
Yeah, and that was certainly an adage that Bill frequently used himself. Again, the idea that diversification doesn't always protect you like you think it does. Certainly we've seen that in a lot of situations, especially crisis situations. You have what's called the correlation of crisis, and the whole idea behind diversification is that you have some things that'll be working and some things that won't at any given time. But what happens in like a financial crisis of 2008 is there's nothing good, and it all goes down, and the correlation, skyrockets. I mean, I can't remember what it was. I did some studies on this, but the correlation was so high in 2008. It was incredible. So yeah, if you had diversified, it just didn't help you at all. Everything was going down.
Even
So
something like gold was probably highly
right,
correlated as well. Because
yeah, it just
if
didn't
you need
matter.
liquidity, if you're getting killed in eight, you have 10 buckets of stuff, and eight of them are really hurting you, but two are really well. Guess what? Let's reduce those two that are doing really well because we need to, plug some holes in the boat over here, and so eventually they all go down, right? Yeah.
But one of the things I also want to address, I mean, it's you mentioned Nvidia, and I own a position in this myself. It had such a strong move after earnings. Actually, when we were taping for the podcast last week, we were kind of looking at Nvidia out of our side eye, just watching it go up. 20%, 25%. Now it's we were watching it do all this action in after hours, and certainly Nvidia sparked a big move in the Nasdaq Composite, the Nasdaq 100 even more so if we look at QQQ. But we certainly were getting to a point where we were extended. So we saw a reversal on Tuesday, downside reversal or stalling action, if you will. Um, does that kind of track with what was expected? And does that mean you sell into that strength and wait, or do you just kind of say, okay, it's going to come in a little bit, I'm going to hold? How do you handle that when things get extended like that? And we've been talking about things being extended for a long time,
Yeah.
and they just kept on getting more extended. So,
Usually, so to me, when they gap up, if they're extended and then they gap up, I'm almost always like 99% of the time going to do some, if not a lot, if not all selling into that.
mhm,
And Nvidia was already strong. It gapped up immense on the earnings, held that day. So, there was a lot of talk, and it still is, that, it's overvalued. It's this, is that, it's a bubble, it's all of that. But to me, the price is the price.
mhm,
And they voted, the biggest institutions in the world voted, and the stock didn't go down. And then the very next day, it didn't go down again. And so you get these clues. You have to be open. I understand, the argument that it's overvalued, but um, from a price standpoint, it sure doesn't act like it wanted to go down until yesterday. It gapped up, and at one point, I think it was up maybe 20, 25 points. And this is the other thing about being concentrated, which is, it makes a difference to your portfolio. So you almost have to do some selling, I think,
mhm,
because the numbers can get pretty large. And And then you have to ask yourself, like today, uh, what can I withstand? You know,
Hmm.
and I mean, it's the math is cruel. I think the stock's already 10% off the high,
Right.
8% as we sit here. But so maybe it's almost corrected 10% already in a session and a half. So
And with a concentrated position, you feel that.
what
It's
I know what I will do. If I don't sell it when it's good, I will sell it when it's bad. So yesterday
right.
I did some selling on the open. It was like 405 and I'm doing selling and then it's 410 and I do a little more selling and then it's 415 and it's frustrating for sure cuz every time you sell it it's higher. But if I don't, I know today at one point, it was 385 and I'll just be, ready to puke my guts out. And so
Hmm.
I'm always better off taking some off into the strength. And so I think if you want to hold it, pick a number or pick a percentage and say, I'm going to keep 2% and just not sell it unless it really breaks and violates my stop loss or my sell rule. Or if it's 5%, I'll speak from my personal. I don't think you can own, at least for me, more a 10% or more position and not do trimming when it's good.
Hmm.
I've never been able to. I've tried. I've tried the Amgen, the Bill story. I've tried it 100 times in my career, Justin, and I've never been able to withstand the pain. That's what made Bill so great is that that fortitude that he had, and so knowing yourself is a very valuable um, thing as a trader because uh, if I'm going to quote unquote panic at 385, I might as well just panic at 405. It's a much better price.
Right. Yeah. Well, and you know what? I want to be clear because again, I remember looking at the trades of Amgen at one point because I wanted to learn and um it wasn't like it was a single buy at the buy point, a hold through this big move, and then a sell, when things were, crossing the 10-week moving average line. It was hundreds of buys along the way. It was, a lot of adding on the way up, um, some trimming as it, came in, and then adding those shares back. It was a lot of bending with the breeze as opposed to single decisions, putting it all in at once. It was building up the position, trimming it back, building it up again, trimming it back, and then eventually, getting out while the getting was still good. So it's definitely not as simple as we sometimes make it sound. It's a lot of small decisions all along the way.
Yeah, I know Charles and Mike, when they shared an office with Bill, said they would hear him on the phone in the old days when you call an order,
Yeah,
and they knew that he had tens of thousands of XYZ already, and he'd buy 100 shares. And
exactly.
they
All the
thought,
time.
well, what's that going to do?
100
What's the
shares on
point?
a $30 stock even,
Yeah,
sometimes,
but if he did
Yeah,
that 47 times over the
yeah,
next 6 months and the stock doubled, you can see
yeah.
how it just compounds. And that when I heard that, it made me
Mhm,
feel very much better because that's exactly what I do. I might buy a stock a dozen times, just kind of picking at it, building the position. That same way, obviously not in the same size
mhm.
as a Bill O'Neill, but relative to my account size, same
Yeah,
from a percentage standpoint, trying to do the same thing.
yeah. So you know what? We'll go ahead and take a break real quick, and when we come back, we're going to share a few more stories of Bill, the way he invested, and again, the legacy that he left with such a great life that shared so much knowledge with so many people. Stay tuned. We'll be right back. Investors with concentrated equity holdings often have a reluctance to exit their position due to the potential tax burden and other considerations. This creates an unbalanced risk profile in their portfolio. The North Coast Concentrated Stock Triple Play strategy uses options pricing models to help clients in these situations hedge risk and create premium income. The proprietary approach also makes use of North Coast's market exposure model, which looks at 40 different data sets, and a stock scoring model, which considers more than 20 factors. For more information, visit www.northcoastam.com/triple play. Welcome back to the Investing with IBD podcast. It's Justin Nielsen, and joining me this week is Scott St. Clair, who is the manager of our premium products group at Investors Business Daily. So, MarketSmith is kind of his little baby that he helps with, and again, he's kind of filling in for Arusha this week for our We Time episode, just as he filled in for Arusha as the MarketSmith manager. But as I mentioned earlier, we did lose our founder, Investors Business Daily's, chairman and founder for so long in this weekend, this Memorial weekend. Bill O'Neill passed away, and he was 90 years old. I worked as his assistant from September 1999 until he retired. I kind of came in and out. I was managing the day-to-day stuff early on, and then I would do special projects for him. But I kind of held a role as his assistant for 15 years. And I mean, I'll just share real quick that when I got exposed to his book, How to Make Money in Stocks, it was after I had already gotten a job at Investors Business Daily. I was a customer service agent to start. I did not know a single thing about the market. I didn't know what the Dow Jones Industrial Average was. But I got hired for the job. It was supposed to be a 1-year job that I was going to do and then move on into teaching. And I read the book, and I was just, I got the book when I was when I was hired. I read it and just absolutely fell in love with it. I just thought it was so interesting. And we were talking at the break. I think one of the things that just kind of struck me was the belief, like, oh, here's like the instruction manual, and this seems like something I can do. And that's where it started. And I had the benefit, even while I was in customer service and I had moved into an education role after a year. Bill O'Neill would come down and give us instruction, because he really looked at customer service as the front line of finding out what the customers were thinking, what their struggles were. So he was always very curious to find out what was happening in customer service, to kind of get that sense from from customers. In fact, when I first started working, I was a little shocked, because I was training and I'm taking phone calls, and a few desks down there were these big long tables, and every now and then a little light would come on. And what was happening is that CNBC was running commercials for us for 2-week free trials of the paper. And Bill O'Neill wanted to try something out. Rather than having a outside company take those calls and just jot people's names down, he wanted to find out a little bit more about the customer. And in order to do that, he wanted to take those in-house. But with all those people calling at once, we didn't have the manpower to take all those calls. So what he would do is he would gather everyone in the building almost. So Bill O'Neill would be on the phone, Scott O'Neill, his son, who was the publisher at the time, Wes Mann, the editor in chief, Chris Gessel, writer of The Big Picture. It would just be, you would call this 800 number from CNBC, and you could potentially be speaking to Bill O'Neill. He would answer the phone and take down your information to send you a 2-week free trial, and he'd talk and say, why, what made you call? What is it that you're interested in doing? What kind of investing do you do? So again, that was when I first started, and I just really got the sense of, you know, certainly he didn't feel like this was beneath him, to take the phone calls. So as a customer service agent taking 100 calls a day, I'm like, well, uh, I can take these calls because Bill O'Neill's sitting right there taking calls along with me. What about you, Scott? What's something that kind of struck you as you started working for the firm? You certainly had a lot more experience in the market at the time that you started working for the firm.
Yeah, I started out as a stockbroker, a lot like Bill. Bill started out as a
Hmm.
stockbroker. Bill started out, with no clients, cold calling, just like I did, and I was at a firm in I was struggling. I was making maybe $600 a month. Now, this was in the mid 90s, so 600 was a lot more then than it is now, but it was not a lot. And I was pretty, ready to quit. I wasn't, I just didn't get it. I wasn't doing it well at the firm I was at. And a friend of mine knew that I was going to quit. And he says, I have a friend that's interested in training somebody. Are you interested in going to work for him? And at that point, I was interested in anything different. So he called me and he says, go get this book called How to Make Money in Stocks. And so I, at the end of the day, I got in my car and I drove to a bookstore because that's what you did in
Yeah.
1995. And I had to go to 3 bookstores to find it. And then I got the book, the white edition, and I
Hmm.
went home, started reading it. And then he called me and was mentoring me a little bit. And then he says, I'll never forget. He says, pull up XYZ. And I said, well, I don't have a quote machine, because
Hmm.
where we sat, quote machines were expensive, and so we had one that sat on this rotating desk in the middle. There was 4 brokers that looked at each other while we smiled and dialed, and you would share the quote machine. And there was like a senior broker who, since he was a senior broker, he dominated the quote machine. I said,
Hmm.
I don't have a quote machine. So I had to beg the senior broker, can I look at the quote machine, please? So I turn it around and he says, watch XYZ, it's going to move. And I said, how could you possibly know that? Nothing, where we were at, nothing ever moved except down. And the stock was breaking out of a base. And so he knew it would have a little bit of ump probably out of the base, and it went up. I don't remember, a little bit, few percent, but just the fact that it went up, and I was just like mesmerized that this could happen. So I read the book. I went to work for him. I started to immerse myself in the system. I would go to live events with Bill and David Ryan.
Hmm.
I distinctly remember paying, I think, $5.99 for the very first one, and then the next one was $599, and the next one was half off. I think if
Hmm.
you ever went again, it was always half off.
Yeah.
So I used to get Bill O'Neill and David Ryan for for a weekend, or a Saturday,
Hmm.
for a few $100s. Um, what an amazing experience! And so I just started, doing it. And then, look, it was 1995. We were in a big bull market, so don't confuse brains with a bull market. But I believed, Bill had me believing that I could do it, that I could make big money in the stock market, that I could change my life. Remember, I'm getting a check for $600 a month, ready to quit and do anything just to survive. And I just believed him. I just felt like he was showing you the way to change your life. So fast forward, it's March 1995, and I get my first kind of real check. I got a check for $5,000, and I put 3,500 of it in the stock market.
Hmm.
And can you imagine? It was all my net worth, but I wanted it all in the stock market. And you buy a stock here and you buy a stock there, and all of a sudden it's working, and I'm putting more money in. And I'm using tremendous margin at this point, and I took my account up a zillion fold. It was just an incredible year in 1995. And his owe it all to Bill. I mean, I was telling you before, off air. Me and Arusha used to joke that he should have kept this to himself. He
Right.
cost himself a bloody fortune sharing this with everybody, because he probably could have just had hired a team of traders and had them sign an NDA and go to work. This is what you guys do. So
Mhm.
um,
Well, a lot of times he would say, actually, this is not my system. This is just the way the market works.
yeah,
And I'm just kind of showing what I observed and what the data says. But he would kind of very humbly say, this isn't my system. This is just This is just what I've observed the market does. And I think you're absolutely right. There's two elements to that. The fact that he shared this with everyone, and not only that, but I mean, how quickly when he would learn something new, how quickly he would share it with so many people. Again,
Yeah.
not holding it. I remember in the aughts when we had this database going back to the '60s of all of these stocks, right? And you could just pull up anything, and it was amazing. And then he went back, and this was I think we had used some of the data from the Chicago Business School. They had some data going back for like RCA and some of the original Dow components going back to the '20s, and it was monthly data. And he was fascinated by like this data that we got from them for some projects that we were working on. And so what he ended up doing was filling in this back data going all the way to the 1880s, so he could see charts, some of these for the very first time, of what these stocks looked like in the 1880s, 1910s, and everything. The charts that weren't printed at the time, that were just the little boys writing on chalkboards, to make the visual image. And almost as soon as this data was complete, we were pumping out this pumping out these charts for people. And one of the first things he did was in the fourth edition of How to Make Money in Stocks. That's the orange book, or the green book, with a little bonus chapter. He printed 100 charts, some of these going back to that time. So yeah, that willingness to share the information. And let's be honest, I mean, starting a paper is not an inexpensive venture. It's something that is very capital intensive. And if he had decided in 1984 to just keep that money and invest it in the stock market, and he would have been at a very different place. So you see a lot of these folks that are on the Forbes list and stuff, and I don't know where Bill fell in that, but there were a lot of decisions that he made that were not really for the personal wealth gain. They were for getting the information out. So yeah, that sharing aspect, as you said, Scott, huge.
I think and I hope it was Charles Harris, because I think it was Charles who said that Bill once told him that IBD was the one stop loss that he didn't never honored.
Yeah.
He kept throwing good money after bad.
Yeah.
So he proved he was human with IBD.
Well, and there was a different reason for it. It was more of a way to give back and help. He always had a soft spot for the little person, right? Because that's he grew up from humble beginnings. Born in Oklahoma, Dust Bowl time period, Depression era. He was born in '33, so he kind of saw that devastating part of what happened in America, and and so many of the parents at the time, and I mean, his dad left at an early age, and so he was raised by his mom and an aunt that I know that he was very close with. And um, he had to get jobs when he was very young. So he always had a respect for the little jobs, right? Getting a paper route, doing anything you can to bring in extra money so that you can better yourself. And you know certainly it was one of those things where he grew up from that standpoint, knowing that it could be done, and wanting to help other people that were, again, willing to put in the work, because that was another part of it. He was very clear that this is not something that they're going to hand you on a silver platter. It does require work, it does require study, and you might not get it after the first year. You might have to slog along learning some of these lessons and make mistakes, before you really get it nailed down. And even after you get it nailed down, there's still going to be curveballs that come your way, that throw you around, and it's one of those things that you constantly have to be learning. So
Yeah, the mistakes part is key. I know Risha talked about on IBD Live, and if anyone out there didn't get that chance to watch the segment you guys did on IBD Live yesterday, I believe,
Yeah.
It's on YouTube and it's on IBD. You can find it. But David Ryan and
David Ryan did
yourself,
a very touching,
yeah, David Ryan's was awesome. Jim Roper
mhm,
was great.
mhm,
Charles, it
mhm.
was really, really good. It was put together, piecemeal last second. Ali's calling everybody, but it was really, really good. So I'd encourage everybody to watch that. And Rusha texted me, he's like, "How come you're not on this?" And I was like, I don't know, Rusha. I don't want to. I don't know what if there's anything I could say that you guys haven't already said so much more eloquently than I would ever say it. I didn't want to ruin the moment.
Mhm.
And I never interacted that closely with Bill like you yourself or Charles. When I was on the portfolio management team, Bill was he was basically retired, so it was more Scott O'Neill and Steve Birch,
Mhm.
who have obviously tremendous interaction with Bill. Scott is Bill's son, and but Steve has worked for the company forever.
Yeah.
But and I got off track a little bit. I'm sorry, but what I wanted to say when I mentioned Scott O'Neill reminded me is the mistake part, because that's what I really love about Bill's system versus not everyone on Wall Street, but a lot of them. They never honor their mistakes. They just let them um, go by the wayside or ignore them. And this is a mistake-filled game. It's
Yeah.
very, very different. This is like baseball. That's why Bill loved baseball. You
Mhm.
can go to the Baseball Hall of Fame and be wrong 6.5 times out of 10.
Mhm.
If you get on base 3.5, 4 times out of 10, you're one of the best baseball players in the history of baseball. And that's a lot like how investing is. But Scott O'Neill tells a great story. When he started as a portfolio manager, when he had company money, it was in 2000, sometime in 2000, the market had already topped.
Yeah.
He didn't know that at the time, but in hindsight, it had topped. And he was trying stocks and getting stopped out and trying and getting stopped out. And he said, I'd put a little probing position here and there, and it would get stopped. And he was frustrated. And he went to his dad and he said, I'm just, everything I try just kind of blows up. And Bill was like, well, this is good. You're learning how to lose. so, so I started in a time where it was great. It was tremendous. And I went on a huge run, but I learned how to lose in '01, '02, '03. That was when it was a little bit tough for me. I had like a tougher period then.
Mhm.
And Scott learned, in the beginning, although he obviously had been investing in his own
Yeah.
account,
He
but
had he had been investing for a long time, but this was the first
yeah,
time he was investing with Bill's money,
company
with
money.
someone
And
else's
that's a
money.
little different
It's a little
psychologically. That's
different,
that's
right.
a whole
Mhm.
nother podcast. Let me tell you, running your own money and running other people's money, and I have experience in both. That's a 10-part series if you guys ever want to do that. I have a lot of thoughts on that, but
Uh-huh.
yeah. So learning how to lose is a very humbling game, and I think that's why Bill was so good at it, because he was so humble.
Yeah, absolutely. I mean, there absolutely is that humbleness, and the recognition that you're if you manage your risk properly, that you can have six losses out of 10 and still make a fortune, and that was one of the big points that he made to me a number of times. I remember there was one of the times that I was accompanying him. He was speaking on Kudlow and Kramer. Remember, Larry Kudlow and Jim
Yeah.
Kramer had a show together, and we had flown out. We were at one of those advanced investment workshops that you mentioned. I think it was 7.99 at the time, and he was in New York, and we took a little side trip to. We flew out early so that he could be on Kudlow and Kramer to their studio in New Jersey, and we were chatting a little bit, and he'd asked me about what was going on in my portfolio, and I was sharing how I had round tripped a lot of things, and he asked why I wasn't taking my profits at 20%, and I was saying, oh well, I just thought that one was going to be a big winner. I thought it was going to be a 100% winner, and he's like, what is it about you that you think everything you touch is going to be gold? That he said, I've been doing this for almost 50 years, and I make mistakes all the time. I expect 3 or 4 out of 10 stocks to be losers, and that maybe I'll get flat or a small gain on 3 or 4, and it's going to be 1 or 2 that are those big ones that make the difference. So he said, you can't treat everything like it's going to be that big big killer stock for yourself. And it just reminded me again of kind of my place in things, and the recognition that you put on a lot of different trades, and then you kind of let the market tell you, oh, you've got a big one here. It's that feedback that you get, that can really tell you when things are different. But yeah, I think we can both agree, and many of our listeners out there, that what Bill O'Neill started back in 1984 for the paper, but really back in 1963 when he started William O'Neill and Company, started giving data to institutional investors, eventually starting daily graphs for more of the retail investor in the early 70s, culminating in the paper in 1984, the multiple seminars that he gave. I remember that, again, he was doing those seminars for such a low price. Again, considering you would get David Ryan there with him, or
Hmm.
one of the portfolio managers. And then there was a period of time where, shortly after the book came out, How to Make Money in Stocks, or even The Successful Investor, he would go out and he would do free seminars. He would just go out and say, what, I want to talk to people and find out what, especially after the financial crisis, he knew that so many people got hit so hard. He just wanted to find out what was going on, what they were struggling with. And so he was doing free seminars. He'd speak for 3 hours for free. And this was in the 2000s, after, he was already established. He didn't have to do that, but he wanted to get out there and get the message out and help people. So it was just, again, really, really amazing how dedicated he was to improving the lives of so many people. So, any final thoughts there, Scott?
No, no, I think it's well said. Uh, sad day, life well lived, and I think I just want to say thanks. I guess that's the best thing to say.
I couldn't agree with you more. I mean, I just think of the trajectory that my life is on now, um, and how much he impacted that trajectory. You think of those meteors that can knock something off course in the cosmos, and I'm just grateful that the the meteor that was, or maybe the asteroid or planet that was Bill O'Neill, kind of hit this little meteor, and put me on the course that I was on. So when we come back, we'll talk a little bit about the stocks that are on our radar right now. So stay tuned. We'll be right back. Investors with concentrated equity holdings often have a reluctance to exit their position due to the potential tax burden and other considerations. This creates an unbalanced risk profile in their portfolio. The North Coast Concentrated Stock Triple Play strategy uses options pricing models to help clients in these situations hedge risk and create premium income. The proprietary approach also makes use of North Coast's market exposure model, which looks at 40 different data sets, and a stock scoring model, which considers more than 20 factors. For more information, visit www.northcoastam.com/triple play. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Scott St. Clair, who's filling in for Arusha as my partner in crime for the little wee time. Scott St. Clair, of course, is one of the managers at our premium products group, or I should say, not one of the managers, the manager, but also one of the coaches. He's done a lot of different jobs for us. He was a portfolio manager at one point. Just always seems to pick up those scraps, as you said, of Arusha's. So here he is again. But yeah, let's talk a little bit about some of the stocks that are on your radar, and let's start with Path. Um, Now, of course, the computer software enterprise group has really been uh, one of those, you know, come back from the dead stories. I mean, the computer software enterprise group. I'm gonna pull up the group real quick and show what this group looks like, because you really see how in 2021 this topped and just got decimated as a group here. But let's take a look at Path. This certainly was right there in terms of the downtrend move. What what about this intrigues you about a possible comeback here for Path?
There are a number of things that what you showed from the weekly is, it's corrected a lot. And that seems to be kind of the MO in the last 10, 15 years. I studied a lot of IPOs. If the IPO base doesn't work, if it takes out those lows like this one did, um, it takes a while, like a number of years for them to kind of round out and come back. Some of them do not come back, but the
Hmm.
ones that do, like a Ring Central or a Twilio or trying to think of Team. Team was
Hmm.
it
Right,
didn't quite
Atlassian.
correct as much as this, but yeah, Atlassian. But they turn out to be tremendous winners because you have that new, right? So Path is new. They've gone public within the last kind of 5, 6 year window, which is what we're
Yeah,
looking
almost
for.
at the top is where their IPO came out of the
Well, and
computer software enterprise.
that's
Yeah,
kind of the problem with the IPOs is it's like right now there are very few IPOs, right?
right. Hmm.
So because at least coming off of a bear market, it's hard to go public. The investment bankers are a little bit probably more stingy as far as the quality. When you're in the midst of a tremendous bull market, anything can go public, and so it's hard to separate the wheat from the chaff, and that's why the bear markets do that job for you. So we've had this bear market last year, and so the ones that come back are very interesting to me. Now, Path is, it's got a little bit of that AI in there, so
Hmm.
that's both good and bad. You have a little bit of hype maybe, but they announced earnings and the stock gap down, about 4 trading days ago. It was down as much as, or closed down 11%, was down as much as maybe 15%. Earnings were up 467%, which is pretty good, obviously. The revenue it was okay, 18%, not great, but it was okay. But the stock didn't keep going down. And that's interesting to me because I really, I don't know who said it. I'm stealing it from somebody, but if the stock is supposed to go down and doesn't, it's probably a buy.
Hmm.
And works the other way. If it's supposed to go up and doesn't, it's
Right.
probably a sell. So, the stock reacts poorly to the earnings. It should go down or stay down, and it doesn't. It's gotten back all of that move and then some in 3 trading sessions. So that looks like a pretty good shakeout to me. Like somebody out there, I don't know who it is, but somebody institutional used that weakness in the stock to either increase their position or build their position. So that type of strength is very intriguing to me. I do own the stock. I bought it yesterday. I'm shoot first, investigate later. So I'll get my starter position 5, 6%, something like that. And then if it can go up, I actually bought a little bit more today to
Hmm.
increase the position. And then if it starts to work, maybe I'll investigate a little bit more. Like, what do they do? Why could this be a big winner? I think Kathy Wood has spoken about this stock as far as the software and the whole AI thing. So I might watch her videos, see what she says, and I'll kind of go down the rabbit hole this weekend. Barring some you know major change in the price action in the next day or two.
Hmm. Now, when something is off so much, I mean, this at least is back above its 200-day moving average line, arguably, um, kind of this bottoming base formation. Do you have like an expectation of, are you like, oh, this could get all the way back to 80 where where it topped out, or are you just kind of more of a take it as it comes?
Yeah, I think you know the answer to that. It's
Rhetorical,
just yeah,
nearly.
exactly. Don't ever ask a question that you don't know the answer to, right? Isn't that one of the or
I
that you
learned that
don't
in
want to
mock
hear?
trial in high school.
Yeah. So yeah, I mean, if it goes to 80, unless it went to 80 tomorrow on a buyout, I won't be there for 80. So I treat it just like any other trade. I'm my goal almost always is because of the size I'm going to use. They get up 15, 20%. Um, I'm normally looking to take some, if not a lot of it off. I kind of have a rule of for every 4 stock. Imagine I owned 8 stocks. and they were all up 20%. Boy, that'd be incredible. I don't think that's ever happened to me, but let's just imagine. I probably would sell six of them completely down, just gone, and I might keep one, and then the
Mhm,
other one I might trim to a
mhm,
smaller position. So I'm out there trying to hit a home run. Every 1 in 8 winners, which just probably means like every 1 in 20, 25 trades, really. That I'm
mhm,
going to hold on to and try to keep it for a really big win. Uh, you know, it's hard for me. I just have a trader mentality. I tend to like to ring the cash register. I like to be in things, unfortunately for me, I made my living from the market for a long, long time. I
right.
was a stockbroker, but I wasn't a very good stockbroker, Justin. I was too busy trading my own account, to be building a book. So, I was, eat what you kill. And so
Yeah,
you tended to turn it over, and develop a little bit of bad habits. Unfortunately, I've tried to kick those since I moved. Partly why I really wanted this to work at William O'Neill IBD so desperately is to really kind of get back on the bike, so to speak, relearn those rules, kind of kick those bad habits. So yeah, I still tend to be a seller into strength, but every once in a while I'll keep something if I know the story, if it has institutional sponsorship, if the earnings and sales, it's got to be really good for me to want to do that.
mhm, yeah. Let's go ahead and switch gears a little bit, not too much though, and talk about Monday.com. Now, Monday it's kind of productivity software, also in the computer software enterprise area. This is based in Israel, and besides the stock, I mean, the stock's been on my radar for a little while. You can kind of pass some billboards every now and then where they tout, how many hours they save people with their software. But more recently, um, the video team, Ali has led them into the Monday.com era, and a lot of their stuff is on Monday.com. So as part of the podcast, a lot of the information that I'm putting in and we're tracking does go into Monday.com, and it's funny because I look at it and our editors have stuff in there, and all the different members of the production. And there's things that they put in there to kind of motivate each other, and there's a lot of emojis, and you're on fire, and all these things. So it's very interesting. It's a very different kind of way of productivity, but it works for a lot of people, and I'm just using a very very small part of it for the podcast. But certainly what we see is that if you kind of take a step back here on the weekly chart, this has had a nice move off of its 40-week moving average line, kind of in 52-week high, new high territory, if not still a ways off those all-time highs. But a lot of these stocks, I mean, I would argue we kind of had an entry here back around 100 and 50 or so. Um, yeah, 156 maybe, and we've had a nice run here. I like that there's some volume coming in on this upside. You had a really nice big gap up on the earnings after earnings. That was a 16.5% gap, or move up. Gapped up and then closed 16.5% up, and you've really been moving up higher since with that accompanying volume. So that's something that's kind of interesting to see. You've got T. Rowe Price New Horizons that is in there, one of the IBD mutual fund index owners. They've doubled up on their position. I'm looking at the December 2022 quarter, and they had, you know, yeah, they've doubled up their position in this last quarter. So that's something that kind of speaks highly of them. Anything that you want to add here in terms of the chart pattern, or the look?
Very, very similar to Path, right? They go public, it tries to go up, you get a bear market, it corrects. Now it's held up a little bit better than Path. I don't know percentage wise how much it went down, but it's just kind of that same setup. And I know Kathy Donnelly and Eve and those guys have, did have that book about, these types of stocks.
The life cycle
But
trade, right?
yeah,
Mhm.
yeah, thank you. And so this has acted very good. I think the buy point, you have to be a little flexible with your buy points, was probably 145.46. That looks kind of like a double bottom
Double
to
bottom,
me.
right?
And, it did gap up on the earnings. And so normally I don't like to buy gap ups on earnings. I like to wait and see if the stock can hold those gains. And what you said is perfect. So it gaps up. Um, and if you wanted to, if you were a seller, stock's up 16%, volume is up almost sixfold. So if you're an institution and you're looking for a place to sell Monday, this is it, right? You've got the
Mhm.
volume footprint, you've got your chance, and nobody steps in to really sell it. So that I think that was, if you missed the 145, around 158-ish or so. And, right here, it's a little bit extended for sure, but it's if you own it, you leave it. It's acting really, really well.
Mhm. And let's go ahead and round out the discussion with CrowdStrike. Now, computer software security, it's been one of those areas where if you look at the industry group ranks from, let's say, 3 months ago, and look at them today, computer software security has come a long way. So we certainly know that this is a group that's here to stay. We're always going to need security software for our protection, from hackers. But now that this is back above its 200-day moving average line, what's your take on CrowdStrike?
Yeah, I like the quarterly earnings and sales, although they are slowing a little bit, but they're slowing from triple digits, so it's hard to maintain, triple digit, that type of momentum. So they've done a really good job fundamentally. And now, technically, this stock, if you go to the weekly, Justin, and this is one of my best stocks in the 2020 bull market, but it was, why am I having a hard time
We can go to the
seeing?
monthly real quick. Uh,
Uh, it
so
was
here's the monthly. So that
yeah, so
2020
it was,
move that it had.
yeah, so it was difficult to buy in that it never built a base.
Hmm.
Really, I mean, there was like a little cup, but that was after the stock had practically doubled or tripled. So it was one of these ones where I remember it was like I was watching it going up, and I was like, how do I get into this? And it just wouldn't build a base. It was one where you just kind of had to, okay, I'm going to buy it, starter position, probing position, whatever you want to call it, and see if it can work. And if it can work, I can add to it. So that's kind of how the stock trades. And so now it's kind of doing the same thing, right? It's coming off the lows, number of weeks up. It built a cupish pattern, but of course it wasn't long enough for the pattern to show up. It's
Hmm.
kind of like that's what the stock does. It just will not let you get this quote unquote perfect buy point, and they just don't always exist. So
Hmm.
um, I've been stalking it, trying to figure out a way to get into it, and I've hesitated the last couple of weeks because I've been waiting for this buy point, never comes, and now we're right into the teeth of earnings. Right, earnings are today, Wednesday at the close. So at this point, I'll wait out the earnings and see. And so if it gaps up, I'll wait for sure. If it gaps down, maybe it can do like a path did, gap down and then recover, or even Snowflake. Kind of, I'm throwing you a curveball here, but Snowflake gap down on the earnings, and it's trying to recover. Not as
Hmm.
strong as path did, right? But it's trying to recover off of that gap down on the earnings. So that would be kind of the setup that I would look for in CrowdStrike.
Great. Well, hey, Scott, I really appreciate you filling in for Arusha, and also filling in for me, because there are a few times where I've been on vacation and you've come on board, which I think is going to happen in June since I'll be in Europe. So I'm going to say thank you in advance for
All
taking
right.
taking one of those those episodes from me. Hopefully you don't push me out though. You get a lot of positive feedback, and of course, folks can see you on your own. Uh, Weekly webinar that you do. Uh, is this just for MarketSmith subscribers, or?
Yes, it's on the Marcus Smith homepage, but it does get uploaded to our YouTube channel. So if you're not a subscriber, you can watch on YouTube.
And so where would they find that? On just the regularinvestors.com YouTube
It's
channel?
on the Oh no, Marcus Smith has their own YouTube channel.
Okay.
Yeah, yeah. So
Mhm.
if you search Marcus Smith, you'd find us on YouTube. Yep.
Wonderful. And then on the show next week, we're going to have Will Ryan back on the show. Will really helps us kind of knock into a little bit of what's going on with the commodities, and so it'll be great to have him on. So hope you join us for that. Thanks a lot for watching us this week, and we'll see you next time.